Is the sell-off finally over? Is the pain finally done? Stock markets find a way higher after 3 weeks of bloodletting. So is all okay now? Well, maybe not quite. Welcome to Macro Money. This is Ilya Spivak, head of Global Macro here at tastylive. And we're going to look at what is going to be shaping this price action this week and why stocks still look vulnerable. Now, that does not, of course, mean that they're going to fall tomorrow. It doesn't mean that they're going to fall the day after that. But the setup here certainly looking troublesome. Let's go down the list of what might influence the conversation and see how to position for it. So, one of the key things, of course, that we've been looking at in attempting to understand exactly what is driving these markets has been monitoring the Fed outlook against what the global economy appears to be doing. And so we're going to get a big check-in on this week. The August set of PMI numbers is going to be with us, and do ignore where it says June there. That's not correct. We'll correct that in post for August. But the expectations here looking pretty dire. The view on manufacturing, services, and composite PMIs from these key economies, at best, in the case of the Eurozone and the U.S., static for manufacturing in contraction territory. As you'll recall, PMI numbers operate on a system whereby they're based around the 50 level. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So what we see from the Eurozone and U.S. manufacturing PMIs here, you can see by the white arrow there, is stasis in contraction territory. So we're going to keep shrinking, but not at any different of a rate. And that's as good as it gets, seemingly. Because across all the other metrics, composite numbers, service sector numbers, we are looking at either faster contraction or slower growth. Eurozone looks like it's going to shrink at a faster rate. The UK looks like it's going to grow at a slower rate. So too the US. So the story seemingly one of a global recession risk that's growing. And of course, this is something that we've been watching for quite a while. We can see what the dynamics are here. This is the JP Morgan Global PMI that captures the trends worldwide. And you can see here that since the beginning of the year, really, and since late last year, where it starts, global manufacturing has been in contraction. That's a slowdown in global economic activity, really not surprising to see after a year of very spirited interest rate hikes from a whole host of central banks, led, of course, by the Fed, and where the Fed has arguably been the most impactful because the dollar remains the quintessential unit of commercial exchange. So when the Fed does something as dramatic as raise rates 400, 500%, as it has over the past year or so, taking rates from essentially 0 to now 5.25% to 5.5% for the target range, you're going to see a very significant rise in the cost of financing economic activity. And of course, that's going to hit immediately on trade, which very much relies on things like letters of credit in order to function. And so, not surprisingly, that has been a significant dampening effect on what's going on the manufacturing side of things. Services had a bit of a pop at the beginning of the year. ostensibly encouraged by more broad-based reopening. Certainly China coming on board was something of a positive influence, at least for a month or two, unlocking all of those consumers out of their draconian zero COVID limitations was something of a boost. The U.S. had a nice boost still left in it in the service sector. It seemed like all the savings from the various stimulus efforts, as well as from not spending on service type activity during the pandemic when everything was on lockdown, and then re-engaging with things like restaurants and travel and events, all of those things really starting to create more activity, more businesses opting away from full-time work from home arrangements and starting to ask folks to come into the office at least some days of the week. That seems to have reactivated services that support that in the areas where those commercial districts and those office spaces are. So a bit of a pop in services at the beginning of the year. And of course, since services are the dominant bit of economic growth in most economies, that lifted overall performance here. You can see the service sector and the composite numbers moving in tandem together and then flailing over the past 2 months. So that dividend from leftover savings, from post-COVID readjustments to service demand, from people easing back on goods demand, which is what fundamentally was the driver during the pandemic while everybody was on lockdown, all of that seems to have been spent. And so now the service sector is catching up on the downside and toward manufacturing, which is pulling global growth downward. Now, this is a ubiquitous story. You can see it in spades for developed markets. This is a PMI setup restricted to them. You can see manufacturing is even worse here than it is for the globe writ large. And the pullback in the service sector even more significant, with a composite number that's getting very close to idling. You can see the same thing for emerging markets. Here, manufacturing is doing a tad bit better in that it is basically at standstill. Services are cooling, as is the composite reading. So the overall story here, very much speaking to this idea that there is a coordinated, broad-based deceleration of global demand that's ongoing. And looking at the numbers that we're expecting to see for this round of reporting for August's surveys, it seems to suggest that things are going to get worse, that this slowdown is going to get deeper and wider spread. And that, of course, is something that bodes ill for stocks, bodes ill for generally cyclically minded assets like copper, like crude oil, and might hurt adjacent currencies like the Australian dollar or the Canadian dollar. Alternatively, it might remain supportive for the likes of the US dollar, the Japanese yen, and it might certainly start to, as it has been, offer a bit more support to bond markets. Now, we've seen the market speculate that the Fed might hold rates higher for longer, and we'll get to that in just a moment, but that bonds aren't breaking down here past their trend-defining levels, that they're lower but not certainly showing the kind of vigor that we see in the sell-off in stocks. That might suggest that actually there is a degree of support from haven demand already emerging, that gold isn't lower than it is in an environment where yields are higher and the US dollar is stronger, might suggest that there is already a degree of speculation that this global recession is afoot. That the yen has been able, in particular over the past 48 hours of last week, Thursday, Friday, that it was able to rally without the dollar falling against most other currencies. The yen is, of course, a risk-minded, yields-minded kind of animal. That seemingly suggests that worries about this are spreading. And that's not without good reason. If the Eurozone is going to get closer to confirming a recession based on these numbers, and China can't seemingly get off the mat since getting rid of these COVID restrictions back in December, well, then the last bit standing is the U.S. And there's a Fed issue. But before we get to that Fed issue, the other major story this week between these PMI numbers and the Fed news of the week will be earnings from NVIDIA, which has become a kind of catch-all name to capture the excitement around artificial intelligence and the technological revolution that has become the dominant story in tech shares, certainly, and the tech shares story has then spread to the broader market. Let's not forget, of course, that some of the largest market cap companies, and therefore those companies with the biggest capacity to move markets along with them, generally exist in the tech space at this point. You can see here, NVIDIA is tracking right alongside NASDAQ, represented by NQ futures here. So you can see that the story is overwhelmingly adjacent. You can also see that when NVIDIA reported earnings last, which was right here toward the end of May the 24th, is when the report is made after hours. So then you can see subsequently on the 25th, a sharp spike in NVIDIA and then in NASDAQ that proceeds to pull markets higher until we get this most recent deceleration in August. It gets more dramatic yet. Stepping away from the NASDAQ, which is, of course, very tech-heavy, and to something more catch-all like the S&P, really shows how much of this story has been tech. So the orange line here is the S&P excluding the tech sector, and the dark line is just the baseline index, and what this tracks are returns since the beginning of the year. You can see here, were it not for tech, performance is about halved. So we're in a situation where tech is very much a part of this story and a driving part of it. Now, where this overlaps with the macro of the situation is NVIDIA, though it is, of course, a poster child for creating the software and the hardware to power some of this AI hope and wish-making for another tremendous technological breakthrough that will power efficiency, power growth, create multiple expansion, create earnings, is that NVIDIA generally doesn't make things itself. It outsources. It is what's called a fabless manufacturer, as in without fabrication. Now, it has deep supply chains across which are a multitude of different fabrication centers. But of course, a major part of the story is China. And as we've just said, the situation in China is looking increasingly dire, at least from a growth perspective. We just saw yet another announcement of rate cuts over the weekend, which underwhelmed markets. So it still seems like Beijing is not prepared to throw the kitchen sink at stimulus, and it's showing because the economy is very much struggling to generate domestic demand at the same time that external demand, the typical engine for growth, is sputtering because China took an extra year of lockdowns after its main customers in the Eurozone and the US were already reopening, which of course encouraged them to diversify their supply chains away from China, at least to some extent. And likewise, an increasing consensus amongst those customers that China's recent assertiveness and more combative stance on a whole range of issues has made it problematic. And so we have a situation where China is in dire straits, and much of the tech sector, and certainly much of the AI space, as epitomized by NVIDIA, is very sensitive to a robust China. So it's not so much that this particular earnings report might be scary. The outcome is likely to be generally supportive when we look at the actual numbers. But the guidance going forward, in that it flags some of these concerns and puts a spotlight on them, might well be a bit more dour than the markets want to hear. And so it'll be very interesting to hear not so much what NVIDIA reports, at least from the macro point of view here, but what NVIDIA says about what now is on the horizon. Because demand from its gaming division to its auto division might well be undercut because Chinese consumer demand and domestic demand in general is weak, at the same time that issues with China's capacity to be the value add center that it was before are undermining their ability to be a good supply chain partner for intermediate and finished goods that then a company like NVIDIA needs in order to do what they do. So we're potentially in a situation where this darling of the markets over recent months might well report something that spooks investors about where we're going, not so much where we are or where we've been, which could add to this global recession narrative that is developing. And finally, on Friday, we will hear from Fed Chair Jerome Powell at the annual Jackson Hole Symposium in Wyoming. This is a gathering of Fed officials and other big monetary policy and macroeconomic thinkers, from academics to policy officials at other central banks to policy officials at big international institutions like the IMF and the World Bank. So this is going to be very closely watched. The speech is generally, over recent years, emerged as a kind of lens calibration exercise. The Fed is not going to announce policy here. That's for policy meetings of the FOMC committee where voting actually occurs. What this is likely to be, and what it has been in recent years, is an exercise where the Fed comes out and says, here is what we're thinking about. Here is the focus of policy. So as data comes in, as events occur, as news filters out over the course of the next year, view it through this lens, because our reaction function to this news will be determined by that lens. In other words, if you get strong GDP data, what you should interpret is, we're focused on inflation, this means we're going to hold rates higher for longer. As opposed to, oh good, strong GDP data, let's have a party. So herein is a very interesting opportunity and a very powerful opportunity, usually, for the Fed to come out and say, This is where our focus is. Act accordingly. And color how the markets interpret the Fed for the next 6 months at least, a year usually. Now, you can see how this outlook on the Fed has shifted in recent weeks. It's been a little bit more dovish, in particular at the front end, over the past several weeks since the July FOMC meeting on the 26th. Over the past week, what we've noticed is in particular at the back end of the curve, the 2-year, the 3-year numbers, there's been a bit of steepening, especially toward the very longer end, as if to say, indeed, higher for longer. If we look at how this stacks up in terms of policy expectations, though, the changes have been relatively modest, which of course creates opportunities for repricing. The markets still don't see a meaningful chance for a hike in September, just 12%. The cumulative likelihood of one in November is at about 47%, so less than half, less than better than even. And that, of course, is down meaningfully over the past 3-4 weeks or so, from close to 80 at the beginning of the month. The rate expected at the end of next year at 4.36 is about one rate cut less than what was expected about a month ago. So at the beginning of August, we thought we were going to get to 4 by the end of next year. Now it's 4.25 with some change, but of course the Fed uses a range for its policy targets. So 4.36 is just the 4.25 through 4.5 range. So about 1% down from where we are currently. So the markets are pretty well anchored, it seems, in terms of what they're expecting. The changes that we've seen have not been dramatic. And then the question becomes, well, does the Fed want to have a more dramatic change? Is this not what the Fed wants? And to what extent is Powell going to try to move the needle? And as we've argued here before, the Fed is concerned. And the reason it's concerned is because inflation expectations have not moved in months, even though actual CPI, which tends to lag those expectations by about 2 months, as you can see here, was in fact going down, but now looks like maybe has hit a bit of a harder patch as of July. You can see here, that was the first uptick in this decline in CPI. But the real issue here is that looking at the 2-year break even, which is a bond market measure of inflation expectations over 2 years, the 1-year USD inflation swap, a swaps market measure of near-term inflation expectations, they're basically static here, going all the way back to the beginning of the year and a little bit more so. And they're priced basically for perfection. So the Fed is expected to get to its 2% target in 2 years if virtually nothing goes wrong, which is not exactly a comfortable space for the Fed to be. If something were in fact to go wrong, and there's certainly a wide spectrum of what could happen, a worse situation in China, a blow up in that property market, say, which is a risk that has been building, something untoward happening in the war between Russia and Ukraine, say, a food shortage around some of the recent export bans on rice out of India, coupled with the breakdown of the Russia-Ukraine grain deal. Something along those lines, creating instability in grain import-dependent markets, much as it did in triggering the Arab Spring. Last go-round, there were significant shortages. So lots of things could happen here. And from the Fed's perspective, this doesn't give them any kind of room to maneuver. What's more, since May, an increasingly less dovish Fed policy outlook has not moved the needle. So you can see here, this isn't the expectation for a particular meeting. This is the 12-month outlook for Fed policy rates going forward from any given day since May. You can see it's been rising. It's been inching closer and closer toward the target. So you can see here at this point, 1 year forward from now, rates are expected to be only a touch lower, only about a 25 basis point cut lower than they currently are. And yet, inflation expectations, in this case, benchmarked with that 2-year break even we just saw as yellow bars on the prior chart right here, they haven't really budged. So the Fed, understandably, might be worried that the markets are losing the reaction function to their actions. And to that end, given that everything we've heard from the Fed has been, we're focused on inflation, we might get a hawkish outing at the Jackson Hole speech for Mr. Powell, where he comes out and makes the point emphatic and says, we're not going to be shy about hiking. We're not going to be shy about holding rates higher. We want to get to 2% inflation. And if a recession is what needs to happen to do that, well, then a recession is what has to happen. And so moving these expectations, this, by the way, doesn't mean that the Fed is going to go about triggering recession on purpose. What the Fed needs to do is to rhetorically stress to markets that it is single-minded and it will not retreat. If that message is absorbed, well, then perhaps quite a bit more of those cuts that's baked in already for the second quarter of next year and thereafter, which you can see in spades right here. You can see the first cut already fully baked in for June and a cumulative of about 4 cuts baked in over the course of next year. As I say, down about 1% from current levels on the Fed funds rate. If that's what needs to adjust away, at the same time as we have concerns about global recession growing, and the thing standing in the way of that recession is a U.S. consumer that stands right in the crosshairs of those very same rates that the Fed is going to ostensibly hint will stay higher for longer and slow growth more significantly, well, then that risk-off narrative might well gain momentum. Critically, though, we have quite a few days before the rubber meets the road on a lot of these things. NVIDIA reports earnings overnight from Wednesday into Thursday. The Fed chair speaks on Friday. So there may be quite a bit of correction in stock markets and in risky assets in general after today's moves and over the next day or two. But the risk that the actual news flow ends up ultimately being negative for stocks, positive for the dollar, positive for the yen, and potentially supportive for bonds as more haven demand seeks them out, perhaps even by extension a bit supportive for gold as well, that remains a clear and present danger here. And that is Macro Money for today. We are, as ever, here Monday through Thursday, right after overtime, a show that I do with Chris Vecchio, head of Futures and Forex here at tastylive, where we discuss each day's events after the Wall Street close and try to make sense of them, and then attempt to forecast perhaps what is coming next. I'm also on with Chris for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays, writing for tastylive.com in the news and insight section. In fact, a summary of this very episode will be there already when you watch this. and of course, injecting pithy commentary out into the world via Twitter. Yes, Twitter, at Ilya Spivak. Thanks very much for joining, everybody. See you tomorrow.